The banking crisis isn't over yet, but here's the crazy thing. No matter how bad it gets, Wall Street is gonna win in the end. And when I say Wall Street, I mean those big mega banks, your JP Morgans, your Bank of Americas. These are the protected class, they are the chosen ones, and they'll never lose. This banking crisis is all about the smaller regionals. And just this week, we had a shocking piece of news that just flew under the radar. PacWest Bank, the bank that was on the verge of collapse, has merged with Bank of California. Now, this is a big deal because the regional banks are starting to merge together. They are starting to come together because there's no other choice. If they don't band together, they just can't survive another bank run. And I want us to realize how bad the situation really is. The combined bank is moving to sell their assets to pay down borrowings. And this means selling their assets at a loss to pay back their own debt to shrink their balance sheet. They have to get their liquidity back up just in case there's another deposit flight. And this won't be the last batch of regional banks that will merge to survive. Because on one hand, they can't really afford to pay higher interest rates to depositors, and on the other, their real estate loans are taking time bomb. And let's look at the big disconnect between the banks. The smaller regionals are acting very irrationally while the big banks are actually more responsible. We can see lending by the large banks actually come down since the SVB crisis. They are tightening their standards for loans and shoring up their own balance sheet. Now, the big banks are staying liquid just in case another crisis strikes. But the small banks, they are fearless. Their lending has continued and loans are now even higher than before. It's as if the banking collapse in March never even happened. Now, this is very dangerous. As interest rates continue to go up, this places bigger stress on loan repayments. And if borrowers start to default on their loans, the smaller regional banks will take the brunt of the pain. And that's why we're going to see more mergers, more consolidations happening from the regionals on the verge of collapse. But let's talk about the PacWest merger, because this is going to be one of two templates going forward. Now, the first was a fire sale acquisition of First Republic by JP Morgan, and it was an awesome deal. For just $10 billion to the FDIC, JP Morgan acquired $173 billion worth of loans, $30 billion of securities, and $92 billion of deposits. Now, these are assets that are productive and can generate income as long as you have the holding power. But the smaller regionals are not JP Morgan. These smaller banks have big liquidity issues and they have to merge. Pulling up a story from Reuters, Bank of California and PacWest to merge raised $400 million in equity. And this is going to be the norm going forward. We'll start to see more regional banks come together to merge to save their balance sheets. But if we dig into the details, we can actually see how terrified PacWest really is, because this isn't your typical merger. Between the two, PacWest is the larger bank with $44 billion in total assets. And that's 4 times more than the Bank of California. But PacWest will cease to exist. The combined bank will operate under the Bank of California name. So what is going on? This tells us that PacWest has lost the confidence of customers and they have to rebrand. But look at the final result of the merger. The combined bank will have $25.3 billion in total loans and $30.5 billion in total deposits. They are flipping the script and are increasing their liquidity, not their liabilities. And this is a clear sign of things to come. And the desperation is very obvious if we examine how they raised their money. To finance the merger, they sold $400 million of new bank shares to private equity firms at a price of $12.30 per share. Now, this is a fantastic deal for the PE firms because they already have made a 20% gain. Plus, they are going to own 20% more of the new company with options to buy even more down the road. So Wall Street wins again. In this banking crisis, there will be losers and there will be winners. And just like in the Credit Suisse and the First Republic takeovers, it is the shareholders or the bondholders that get screwed in the end. Now, if you held PacWest shares 12 months back, you are still down over 60%. The merger doesn't really benefit you. It benefits the big money. You are still screwed. And this makes investing in regional banks one of the riskiest propositions around. Because unless you have inside information, this is one game that you probably won't win. But how bad will the banking crisis get? How many more regionals will collapse or merge together? Now, in the United States alone, there were over 4,800 commercial banks in 2022. That's more banks than any other country on planet Earth. And this makes the entire American financial system a walking time bomb. Now, every time a bank collapses or merger happens, we'll see banks move towards selling their assets and paying down their debt. And this will move to consolidate, and the last thing they will do is issue a crazy amount of loans to borrowers. And if you're a big bank, you are just waiting for the smaller regionals to collapse so you can swoop in like a vulture and then eat them up. It's the name of the game. And this is very clear as the FDIC itself now has a liquidity crisis. The financial backstop itself is broke and they are trying to pressurize the big banks to replenish the fund. So if you're a mega bank and you have tons of uninsured deposits, you need to pay a fee to the FDIC, and it is not chump change. According to the estimates, the top 14 banks will have to pay almost $6 billion a year, and that would erode their earnings per share by 3%. If you have dealt with banks before, guys, you know that they don't like to lose money. Whether it's paying depositors or regulators, they won't pay up unless they have no choice. And it's really hilarious and sad at the same time because the banks are playing hide and seek with the FDIC. In a story by Bloomberg, the FDIC warns banks over errors in reporting uninsured deposits. In fact, dozens of banks have revised their uninsured deposit data. And this shouldn't come as a surprise because the more uninsured deposits you have, the bigger the fee you have to pay. Over the past few months, we had a ton of banks reinstating their uninsured deposit amounts. Leading the pack, Bank of America has reduced their uninsured deposits by 13.8%, while Huntington Bank has reduced their declaration by almost 40%. That's a very big drop. And here's the big problem. If the mega banks, they pay less into the FDIC fund, that means there's less buffer to save the regional banks if another collapse happens. And that will lead to one of two things, both of which are extremely bad. Now, the first is the Federal Reserve stepping in to backstop the bleeding. They have to print money again to inject liquidity into the banks. Or the more likely scenario will be more bank takeovers. There'll be bigger fire sales because the FDIC will be too broke to finance any mergers. And that means the big banks can gobble up the smaller regionals for pennies on the dollars. I hate to say this, but this banking crisis is going to empower Wall Street even more. Those at the top will thrive, while those at the bottom will suffer. And there's going to be more pain coming for the banks. I think a lot of us we have forgotten that the situation is even more dire today than a few months back. Now, since the start of the banking crisis in March, total deposits at US commercial banks have fallen from $17.6 trillion down to $17.4 trillion. That's $200 billion gone from the system. That's capital flowing into money markets, US treasuries, and the stock market because everyone is chasing yield. Now, I'm not sure if you realize, but risk taking is bad, guys, and everything out there looks better than a CD in a bank. And the Federal Reserve just made history. They have hiked interest rates to 5.5%. That's the highest level in 22 years. And listen to Powell's statements during the FOMC meeting because it kind of reveals a lot. I would say it's certainly possible that we will raise funds again at the September meeting if the data is warranted. This is a deadly warning from Powell and we need to believe it. Since the start of the rate hikes, Powell has been telegraphing the punches. He has been walking the talk without fail. So at the very least, rates will stay at 5.5% or hit up to 5.75 or even 6% by the end of the year. I've been saying for months now, guys, that the best place with the best risk to reward is US Treasuries on the short end. And that's why I plowed into the money market funds because rates could keep heading up by another 25 or even 50 basis points. And let's think about this for a bit. If the risk-free rate keeps going up, American banks have to remain even more liquid because there are two time bombs that could explode. Now, the first is another bank run from uninsured deposits. And remember that only the first 250 grand in the bank account is guaranteed. The rest is up in the air. And with money markets yielding more after the rate hike, it really doesn't take a genius to see where cash will flow to. Now, the second is even more urgent and it has to do with the commercial property market. We are in a brave new world where workers don't want to head back to the office and mortgages are getting more expensive. And check this out, US commercial property delinquencies have gotten worse in July. Delinquencies means that borrowers are late on their payments to the bank. So as a bank, not only are the value of your mortgage loans going down, but your cash flow is also impacted. The total rate of delinquent loans have risen for the fourth straight month and now stands at 6.44%. In other words, the banks are caught. If the loan defaults, they have to liquidate the borrower's property and take a massive haircut. Now, if they allow for loan extensions, then their cash flow will be impacted at a time where they need liquidity. And this is why the smaller regionals are doubly screwed. The big banks can wait out the storm because their balance sheets are huge, but the regionals can't. So they have to either merge or get acquired. And this is why Wall Street will always win. Guys, I'm not forecasting the end of Wall Street. I'm talking about the decimation of the smaller regional banks and the rise of the mega banks. So after all this chaos settles, the big banks will get even bigger and Wall Street will get even more powerful. But we'll have fewer regionals and power will be consolidated at the top. So I am bearish on the smaller banks but bullish on the G-SIBs, the too big to fail banks. Now in the past, the smaller banks were often traded at a premium to the bigger banks. People love to invest in smaller banks because they could move faster and take on more risk. They could issue more loans to local communities, but the big boys really can't. But things have reversed. In 2023, the big banks are now outperforming the smaller regionals. Since January, the smaller banks have crashed by 25%, while the big boys are only down by 11%. And we can expect this state of affairs to continue. Investors realize that the big banks have staying power. They have more money to weather the storm and they are too big to fail. And when we think about high interest rates, the common understanding is that banks will earn more money. Borrowers will have to pay more to service their loans. And that is especially true for the bigger banks because they aren't afraid of a deposit flight. Now, since the start of the rate hikes in 2022, all the big banks have enjoyed higher net interest income. And that means basically profits on their loans after paying depositors have gone up. Just take a look at JP Morgan's profits. It has almost doubled over the last 18 months. The big banks can keep milking the profits because they don't have to sell their loan assets. The chances of a bank run on JP Morgan is extremely low. So if I had to invest in a bank, it's safer buying to the big boys than the regionals. The JP Morgans of the world are too big to fail. And if the regionals collapse, they will just swoop in and eat them up whole. And every time a fire sale happens, guys, the acquiring bank tends to get stronger. In May 2023, when JP Morgan acquired First Republic, their share price started to rocket up. And as the Fed eventually drops interest rates, all the loan assets of JP Morgan will start to increase in value, making the company even more valuable. And that's why this banking crisis isn't equal. We are not looking at a systemic collapse. This is a preview of the big banks getting even bigger. And I want us to zoom out a little and realize that the Federal Reserve is not going to let Wall Street collapse. The most powerful weapon America has is the financial system, and they won't let it tumble. If Wall Street tanks, then the entire economy will crumble, and America doesn't want to let China or any other country take the lead here. The Federal Reserve has a ton of tools to keep the banking system solvent, even if it looks or sounds extremely ridiculous to us. They will backstop the entire system. Now remember the BTFP, the Bank Term Funding Program, the one where banks can swap their underwater bonds at par value for cash. Now this facility is going to be one of the backstops that I believe won't go away. They have loaned out almost $103 billion to the banks to keep them solvent. And this is why there weren't any more bank collapses after First Republic. So just imagine the amount of magic the Fed will do to keep the system solvent, right? They could create another backstop for real estate loans or God knows what else. And that's why in the long term, it is a very dangerous proposition to bet against the big banks. It's not that I love Wall Street, but the financial system is set up, guys, to protect the financial system. Now, this isn't good news because that means power will be consolidated. When all this dies down, the big banks will be unstoppable and risk-taking will be amped up to 11. So prepare for a future of higher inflation. The casino and riverboat gambling are gonna come back. But let me know what you think in the comments below. Is the banking crisis over? Or will more regional banks collapse or merge? Let me know in the comments below. Stay safe, guys, and be sure to smash the like button and subscribe as we navigate through these crazy times.